Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:48 a.m. Central Time, and I'm recording this in preparation for the market day of February the 2nd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in. A number of very important changes to our daily report and all today. We've got a change to the hedge risk level. Lots happening in today's report. In the morning report, first of all, let's take a look at our overnight action in our own markets. As expected, coming into the first day of the month, we do kind of expect something of a bounce to lead into this day, and the overnight action did just that. It's up about 0.25% on average across the key broad markets. Crude oil is down about 0.5%, as is gold, down about 0.5%. Looks like the euro's up slightly, and bonds basically are scratch. In terms of the overseas markets, China again getting hammered, which has really been a source of significant weakness in recent days. Overnight action over there to start the week. China once again down 2.57%. Hong Kong's basically scratched. Japan's also weak, down 0.66%. And Europe scratched to slightly up, with Germany and the DAX up 0.27%. In terms of macroeconomic reports for this week, there's actually quite a full week, but in terms of U.S. action, today we have ISM manufacturing PMI, as well as core and personal spending. So be looking out for those. I guess frankly they probably have already on the core have already posted, and then later during the trading day we will have that PMI report coming out. In terms of tomorrow, there are no key U.S. coming out. The factory orders, I guess, is an orange flag. You have total vehicle sales, a yellow flag, but nothing really significant on the docket for macroeconomic reports for tomorrow in the U.S. markets. In terms of our current volatility, well, with the month of January, we closed the most volatile month that we have had in several years. So we really have started off this year with quite a bang with respect to these daily ranges. We've now gone into basically a 3-month range. But we are right at the bottom, right at the edge of the cliff, and falling out of that range and breaking down. So short-term volatility right now at 21.17, so certainly up in the upper area of where the VIX has been in recent weeks. You see historical implied percentiles are all in those upper third areas across all 4 markets. In terms of standard deviation moves, with the exception of the NASDAQ, which has been relatively quiet in recent trading days, the other markets are experiencing at least a 1 standard deviation move in back-to-back days. So quite a bit of price action going back and forth in large range days in recent days. All this has really not resulted in very much, in that we are still in the range technically, but we are right on the very edge of the bottom of that range. So it's always dangerous when you're at that bottom edge. So bulls have got a big job today to show that they're going to do something more than just a first day of the month seasonal bounce, and that they're actually going to keep this from going into something much more ugly. In terms of ugly, we have had a number of our indicators turn more ugly, and as a result of that, we're now calling our market trend intermediate term phase opinion back to phase 5. We've been flipping between 3 and 5, and we're on the edge of the break of support. And most of the descriptions of what we could see in this area would fit a better description of phase 5 than 3 at this time. We do still have uptrend under pressure, and from an active trader posture, our market posture is calling for no new short-term or intermediate-term bullish trades. Indeed, I think probably will find that many people will be taking any opportunity of a rally to be selling or positioning for the next down leg. So until proven otherwise, rallies are opportunities for positioning, and pullbacks are where the momentum lies, and are certainly going to be watched very carefully, that we might be breaking down, and you got to watch where those bottoms get to, because we are very much on that edge. Positioning sizing, reducing those position sizes on anything you are doing. Even if you're speculative trading, you should be, given the current volatility, reducing your position sizing. Now, in terms of market opinion, because of the seasonality of the beginning of the month and the fact that we are so oversold, we are expecting a very bullish outlook for the one-day outlook, and 3-day outlook is also bullish. We still are in a long-term bullish trend, so we still maintain a slightly bullish intermediate term expectation, but within that expectation is an awful lot of caveats right now, and indeed our market forecast indicators are all bearish and below 50 now. So not only are they slanted down, they're also below 50, so that really increases the bearishness, also increases our hedge status. It's one of the variables that goes into that. But you'll see that the most important one, the S&P, is below a 50 at a 40.0. Dow 29.0, really in danger of going into a very bearish status if it flips down below a 20. We have elevated to threshold level 2. This is a red light, and what that means to us in the Falcon Global trading community is that we stop all bullish entries, we start bearish directional trades, we may shut down short-term bullish trades, and we will start to invoke long delta bearish hedging strategies as opportunities and market timing presents itself. A lot of flags, market in decline, sharp increase warning has fired on Thursday. We had a VIX spike on Thursday. VIX is obviously over 18. Current distribution days, we now have 5 on the S&P and 4 on the NASDAQ. So that also, when we hit 5 on the S&P, that was of note. Obviously, that our market posture has dropped below a 50 is significant, and 4 of our 5 key intermarket risk aversion indicators have flipped to risk aversion. From an option income strategy, the VIX is now outside the acceptable volatility windows. This has been this way for a couple days, so it is not conducive to option income strategies. Better to focus your energies on directional trading of this range. And let's see what else we want to get into. In terms of our point and figure, a number of updates here. Members, take a closer look at your printed reports to dig into this. But this helps us determine expectations for the bigger trends within these key markets. And then from a sector market posture, again, this has been flipping back and forth because we have been so neutral. The lines are flat, and so any little price up moves everything into the ups, and every time we get down, you know, it gets quite ugly quite quickly. Utilities and healthcare, if we're going to have a rally, they will probably be the first 2 sectors to if you look at the internals in those two, and the general health of the key players within those two sectors, they are most positively positioned for any kind of up move. So if you're going to be doing any kind of speculative trading to the bullish side, which is not called for in our opinions, those would be the first two places to go. Of course, they are also defensive, and that should tell you something about our current market positioning. Those high betas, obviously energy, technology, financials, especially the banks, are being hurt very much by the current yield levels. And until the financials start to recover, we're going to be under a lot of stress. In terms of the percent change, you saw, of course, again, energy keeps bouncing back and forth, and it had an up day on Friday, but you can see it has been very, very negative for quite some time. Other sectors, even utilities here, very ugly day on Friday. So when the markets are down, it's going to carry all the sectors down, and even healthcare and utilities will lose money. That's why we say no new positions at this time with this current hedge status level. In terms of industry groups, if you're working up watch lists for when things do become better, retail, it is benefiting from the gas prices coming down, of course. Railroads, internet, transportation, healthcare, and biotech. Biotech continues to be extremely volatile, but might be one of those areas as a subset of healthcare that, should we stabilize and start to form a bullish trend, biotech and the healthcare index will certainly be benefactors from that. So some places to be aware of as to where strength may come from. Should we have an opportunity to start resetting. But really the word of the day is hedge level 2. We're right on the edge of something that is potentially much, much more significant. And as a result of that, you should be reviewing your current positions. I know over the weekend I was taking a look, making a double check, making sure I had my alerts in place for key price levels, also making sure that all my closing orders are places where I intended them to be. This is the time when you've got to hedge risk level 2. You've got to do your due diligence. You need to know just what exposure, what risk levels you have on. For example, we took a look at all of our core put selling. So what would happen if I were to be assigned all of my core put sells that I currently have on in my portfolio? And where would I be with that margin? And am I prepared to actually own those? So I make that decision when I sell a put against a core portfolio position that I am willing to own those shares. That's part of that strategy. Well, when we get to a hedge risk level 2, now we're really being called into question, okay, were we really meaning that? Were we really prepared to take ownership of all of those puts and to take those shares at those strike prices? And do we have the trading capital available to take the assignment of all those positions? So these are the kinds of things that you should be doing when you see the hedge levels increase like this. And then, of course, the other thing that we're doing in our Falcon Global Trading community is we're taking a look at what is our portfolio delta. What percentage of our portfolio do we potentially want to hedge, especially if we start seeing some of our alerts fire off as we break important support levels? And then when we break those support levels, what are our strategies to invoke? Are we going to put on SPX bear calls or some sort of other bear calls? Are we going to go more directional and put on puts, just long puts? Are we going to use futures? Are we going to use ultra shorts such as the SDOW or SH? A lot of different strategies that you can bring into play that we certainly use in our equities and ETFs room to manage our dynamic portfolio. At the same time, you have to make judgment calls as to when to invoke those various strategies and to what degree. But now is the time to be making those kinds of decisions before you're actually breaking those support levels, and before you're actually in a full-fledged market crash warning and we go to level 3. That is the next level. To go from level 2 to level 3 means we have broken into a significant down move, and that's the kind of stuff where you could see not just 5 to 10% drops, but 20% drops or even greater. Those kinds of things do come with tells. They do come with warnings almost always, and right now you have those warning signs. Be able to prepare your portfolio, be able to prepare your trading positions, whether they're speculative, swing, intermediate, or core portfolio, to make decisions now while you're not in the heat of the day, and to understand where you might need to go. So big day today. Do your homework, be prepared. That way you will make good decisions when you need to, but keep a very, very close eye on your alert levels. You should have alert levels to the key levels of the S&P and other broad market indices breaking down, and if they start triggering those alerts, you start making those judgment calls as to how to best protect your trading capital. And that's what it's all about when you start getting into level 2 and level 3. It's about the protection of your trading capital, and then secondly, the opportunity to make money off of those short-term, high volatile downward thrust. There certainly are trading opportunities there to make money, but the first order of business is the protection of your trading capital and the decisions that go into doing just that. So long recording today, but a very, very important one, because we're at an important and a critical place in our market. So let's wrap this thing up. As always, feedback we greatly appreciate. If you like what you're hearing today, if this is helpful to you, please like us on YouTube. Please tell your friend and other traders that you are in the market with. And then, of course, comments are always welcome. You can send those to support@falconglobaltraders.com. Additional information is available, of course, as always, at our website. Disclaimers, hit the pause button so that you can read this at your own reading timetable. And as always, we greatly appreciate all of you in the Falcon Global Trading community. Good trading and goodbye.